Geopolitical events can significantly influence financial markets, often leading to volatility and shifts in investor sentiment. Here are some key ways in which these events impact markets. 1. Market volatility. Geopolitical events, such as wars, conflicts, terrorist attacks, or significant political changes, can create uncertainty, causing market volatility. Investors often react quickly to news, leading to sharp swings in stock prices, bond yields, and currency values. 1. Risk aversion. During times of geopolitical tension, investors tend to become risk-averse. They might move their investments from equities to safer assets like gold, government bonds, and other safe haven currencies, e.g., US dollar, Swiss franc. 1. Commodity prices. Geopolitical events, especially those involving major commodity-producing regions, can affect commodity prices. For instance, 1. Oil. Conflicts in the Middle East can disrupt the oil supply, leading to higher oil prices. 2. Agricultural products. Trade tensions can impact the supply chain and pricing of agricultural commodities. 1. Exchange rates. Geopolitical instability can lead to fluctuations in exchange rates. The currencies of countries involved in or affected by the events might depreciate due to reduced investor confidence. Conversely, safe haven currencies often appreciate. 1. Trade and economic sanctions. Trade wars and economic sanctions can directly impact markets by altering trade flows, impacting corporate earnings, and affecting economic growth. For instance, tariffs can lead to higher costs for companies and consumers, impacting stock prices and economic forecasts. 1. Investor sentiment. Geopolitical events can shift investor sentiment. Positive resolutions can lead to market rallies, while escalations can result in sell-offs. The overall market mood can be significantly affected by the perceived stability or instability. 1. Sector-specific impacts. Certain sectors may be more affected by geopolitical events than others. For instance, 1. Defense and aerospace. Companies in these sectors might benefit from increased government spending during conflicts. 2. Travel and tourism. These sectors might suffer due to reduced consumer confidence and travel restrictions during geopolitical tensions. Case studies. 1. U.S.-China trade war. The trade war between the U.S. and China resulted in tariffs and retaliatory measures, impacting global supply chains, increasing costs for businesses, and leading to uncertainty in global markets. Companies with significant exposure to Chinese markets or reliant on Chinese manufacturing were particularly affected. 1. Brexit. The UK's decision to leave the European Union created prolonged uncertainty, impacting the British pound and European stock markets. Companies with significant business in the UK or Europe faced uncertainties regarding trade regulations, tariffs, and labor mobility. 1. Russia-Ukraine conflict. The conflict between Russia and Ukraine had significant implications for global energy markets, given Europe's reliance on Russian gas. Sanctions on Russia led to disruptions in various sectors, including energy, commodities, and finance, impacting global markets. Mitigating risks. Investors and companies often take steps to mitigate risks associated with geopolitical events, such as 1. Diversification. Spreading investments across different geographies and asset classes to reduce exposure to any single event. 2. Hedging. Using financial instruments like options, futures, and swaps to hedge against potential losses. 3. Scenario planning. Developing strategies for different geopolitical scenarios to respond swiftly and effectively. Understanding the potential impacts of geopolitical events on markets is crucial for investors and policymakers to navigate the complexities of the global economy effectively.